Disney reported quarterly financial results for its quarter that ended December 28, 2024. The company reported these results on the morning of February 5th, 2025. And usually, when a company reports its quarterly earnings, I take that as an opportunity to update my buy recommendation or hold recommendation on the stock. So that's what I'll do in this video. I'll review Disney's results, compare the new valuation, and then come up with the conclusion whether or not I think the stock is a buy, hold, or a sell. So let's jump in.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
It's for the most recently completed quarter. Disney reported revenue growth of 5% to $24.7 billion. Its earnings per share, however, jumped by 35% to $1.40, up from $1.04 in the same quarter last year. Disney's been doing a good job of controlling costs and increasing prices across the board, whether it's the streaming service, whether it's the theme parks, whether it's the cruise ships or the hotels or food at the parks, parking, etc., etc. I could go on and on. Disney has increased prices meaningfully in the last 4 years since the onset of the pandemic. So I mentioned that Disney's been increasing prices, and some of that resulted in a decrease in subscribers. So for Disney Plus, the company reported 125 million subscribers. That was a decrease of 700,000 from the previous quarter. Disney had forecasted a 100,000 decrease. So the decrease was less than expected. And that's what Disney's been reporting for Disney Plus as the company has raised prices meaningfully. It's reporting that they're not experiencing the cancellations as a result of those higher prices. And Disney Plus started at a price of around $4.99 a month, and I think now it's up all the way to $13 or $14 per month. So they've almost tripled the prices over the last 5 years or so, and they've maintained this growth over the longer term. And that's a result of the industry. I've talked about how important it is to invest in industries that have improving competitive dynamics. It's the opposite of what's happening in the electric vehicle industry. The streaming industry, nearly every participant has been increasing prices and lowering spending, right? They're increasing the subscription fees, they're decreasing content budgets, they're decreasing advertising budgets, they're decreasing incentives, they're clamping down on password sharing. All of these things are good for investors, bad for customers, right? Because you're paying more, but they're good for investors. And it's the opposite with the electric vehicle industry, if you think about it, right? The electric vehicle industry, they've been increasing supply. Right now, almost every car company is coming out with their own electric vehicle model and several models in some cases, and everyone is trying to come out with the next best model. They're lowering prices, competing with each other. They're increasing advertising spending, increasing promotions. All of the things that you dislike to see as an investor is happening in the EV industry. That's why you see nearly every EV stock is down huge over the last 2 or 3 years, except for one, right? And that stock is up not because of electric vehicles, but because of the relationship between the CEO and the president. But for the streaming industry, it's the opposite. You have a very attractive industry for investors. The leader, Netflix, has continued to raise prices, not feeling threatened by the competition, sticking to its guns, and it's paying off for everybody industry-wide. So looking ahead, Disney's forecasting a modest decline in Disney Plus subscribers again for the second quarter. And it's a result of the higher prices and limited spending on new content. They expect to see some churn in Disney Plus subscribers, but Disney's okay with that. They want to make the segment profitable. They're going after profitable growth, not just growth for the number of subscribers in total. For the full year 2025, Disney's forecasting high single-digit growth in earnings per share compared to 2024, and they're forecasting $15 billion in cash flow from operations. And in the previous quarter, when the company gave an outlook for the next few years, they talked about earnings per share are actually accelerating in 2026 and 2027 as those initial investments in the streaming segment are starting to pay off. Disney invested tens of billions of dollars, well, close to $15 billion in total in the launch of the streaming business. And now they're starting to reap the benefits of those investments. So, that being said, it wasn't all great news, and it hasn't been all great news for Disney because Disney is experiencing a huge hit to a big part of its business, and those are the linear networks, the cable and satellite division. Those are declining. People are canceling those subscriptions by the millions, and Disney has a meaningful share in that business, but it's been declining and it's now a relatively smaller portion of its overall business. The linear segment declined by 7% to 2.6 billion, and the operating income in the segment fell by 11% to 1.1 billion. That's down from 1.24 billion. But the direct to consumer segment, the streaming segment, revenues increased by 9% there, and the operating income increased meaningfully from negative 138 million up to 293 million. And what I've been monitoring is the difference in magnitude. So linear networks revenue declined by about 200 million and operating income declined by about 140 million, while streaming revenues jumped by nearly 500 million and operating income jumped by nearly 440 million. So the growth in the streaming segment is outpacing the decline in the linear network segment, which is good to see. And over the longer term, I've been saying that this transition to streaming is going to be beneficial for Disney and the other participants as long as they can execute that transition. The reason being is that when people are streaming subscribers, they're going to watch the content more. There's going to be more demand for streaming content because people can watch it anywhere they have an internet connection on their phone, and people almost always have their phones with them. And so there's an increasing demand. There's going to be increasing watch time, which is going to lead to increasing subscribers and increasing ad revenue on these services. Secondly, there is no middleman now. So Disney doesn't have to go through Comcast or DirecTV and negotiate deals where they could be asked to accept lower prices, right? So they're going direct to consumer. So those are two benefits. And there's one downside, and that is that with the streaming, with the cable subscriptions, they were able to force people to pay for things that they may not be watching in the bundle. So there's that one downside, but two upsides. And ultimately, I think the upsides will outweigh that downside, the bundling benefit that they got from their partners, because they can still do that to some extent with the live TV streaming bundles, right? So over the longer term, I think this will be beneficial for Disney. All right, so Disney stock trades at a forward price to earnings of 18. And when I did my discounted cash flow model on Disney, I found its intrinsic value to be $119 a share, and the current market price is $112 per share. So I would say Disney stock is, between fairly valued and slightly undervalued. And so to update my recommendation, do I think the stock is a buy? I would say yes, the stock is a buy at current prices. I think Disney is an excellent business. And when you have an excellent business, you're fortunate to be able to buy it at a fair value or slightly undervalued, as you can here with Disney. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.